I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show. And this day, this episode is about when is a good time to refinance and roll in other debt that you might have.
Mm-hmm. You know, you hear about these as being debt consolidation loans. And whenever I think of that, I think about advertisements that, come on the air like after 11 o'clock at night or 12 o'clock at night, debt consolidation, balloons and confettis and, get in our personal loan program to consolidate all your debt. So I don't know how good of a ring that has to it, but
right.
But that's what I think of when
I'm with you. That. I'm with you. I hear the radio advertisements. Whenever I hear consolidating debt, when you hear that, what are we dealing with? You're dealing with someone with a lot of debt. There's two different types of consolidating debt, I think, scenarios. People who who basically accumulated so much debt they're behind and they cannot make payments. And I think all those advertisements, there's a whole industry that's trying to help people, through bankruptcies and debt consolidation. They have a whole strategy to take all your debt, bundle it together, and negotiate payments. That's not what we're talking about. We're talking about something obviously very different, refinancing, when borrowers have reasonable debt, but they want to structure it inside of a mortgage, right? They want to take the debt from a car or maybe credit cards, a home equity line of credit, and combine it. When is it good to do that?
Right. And I have it kind of clumped in my head in two different buckets. I have mortgage debt and I have non-mortgage debt. I think you could probably have a third bucket of student loan debt. So you've got student loan debt, you've got mortgage debt, and then you have every other type of debt, whether it's earrings that you've purchased, an engagement ring that you've, financed, a pool loan, a home equity line of credit. Any of that stuff is going to be non-mortgage debt. And the only reason why we're spending our time on this podcast, because all of our podcasts we think are very, very worth it, is it makes sense. And what we're talking about is clumping that non-mortgage, typically it's expensive, debt, and clumping it into the affordable makes a whole lot of sense mortgage debt. So that's the only reason why we're doing this. We are not a debt consolidation company. We don't advertise, high cost loans, to help make one simple payment. We want you to save money. And this just isn't about, one simple payment. This is about how do you get rid of the higher interest rate loans you have and roll them into the most affordable loan you will ever get, besides maybe a super awesome student loan that's got 0% interest rate or something.
Most of the debt you have, student loans, credit cards, personal loans, they're not tax deductible. The interest you pay is not tax deductible. The home equity lines, actually a portion of home equity lines, depending on your accountant, you want to get an accountant to tell you, but a lot of times the interest is not tax deductible on a home equity line because the rules have changed. Student loans, a lot of federal student loans, the interest is tax deductible currently. So again, there's some planning that goes in here, but usually it's higher. We're combining these debts that have higher interest rates and they're not tax deductible.
Mm-hmm. Can I also throw this out too? I hear this from a lot of my borrowers, and I need to probably turn my volume up a little bit or speak a little louder, but I hear a lot of borrowers saying, I don't want to pay off a certain debt because I have 0% interest rate. I'm going to refi and I'm going to cash out, but I don't want to pay off that one credit card because it's 0% interest rate. And those sneak up on people. And, again, nothing in life is for free. You're paying for it in one way or another. And we can probably talk about that later. But anyway, so regardless, even if you have a 0%,
right, a low introductory rate. I don't care if it's Citibank or American Express or Capital One, right? They give you a low introductory rate. You get all excited about it for 12 months and you forget. Then it goes to 8 or 16%. Forget it,
You forget. And also what'll happen, 2 months before you're ready or before that interest rate kicks in, the water heater is going to break. The air conditioning unit is going to break and you're not going to have the money to pay it off. So we like to tackle and tell all of our borrowers any type of consumer debt, Any type of non-mortgage debt, with the exception of student loans, and even though HELOCs, I'm glad you brought that up. HELOCs are a mortgage debt. They're typically an adjustable interest rate, and so get those lumped in to that fixed, long-term, affordable mortgage. That's really, really important.
Yeah. And it's right now we are recording this at a time when interest rates are low. We're not going to say what the interest rates are just because all sorts of regulations prohibit us from telling what rates are. But anyway, rates are low, right? We're at the end of January, filming this January 2021. Interest rates are low. But what we're telling you today applies anytime the interest rates are low. Okay. It could be a couple years from now and you're listening to this. If interest rates are low, then these principles are still valid.
Well, can I also say this too? Even if interest rates are not low and they're just average, my guess is every other type of interest rate that you're going to have on your other debt is going to proportionally be higher. It will typically always make sense to consolidate into your mortgage.
Right. So you want to basically look at where you're currently at, as long as it does make the financial sense. And today, it's almost like every situation makes sense for the refi. Almost every.
And do you remember, Ed, the podcast we had where I said, except for the people that are a little more financially independent and wealthy, the average person will use their mortgage to help finance themselves through almost their entire life. As your home appreciates, as you ride these markets, and as you pick up a little debt along the way, do not be afraid to use that home as a way to finance your life. Make sure that you live within your means, for sure. But I can't tell you the braces that come up, every other year. Again, the air conditioning unit, and you put them on a credit card. Meanwhile, your home's appreciated, $18,000 in the last couple of years.
And we're not advocating, go out there and have a mortgage, but there is mortgage. If there's going to be debt, mortgage is the best debt out there.
Okay. I don't know if you had another thing, but I had one thing. I had a lot of people tell me, because I'll advise this to them, and they'll say, well, I don't want to consolidate my debt. I want to keep my 8-year pool loan. I want to keep my 6-year car loan going. And my credit cards, because I don't want to finance them over 30 years. I say, no problem. Guess what? You don't need to. Okay. So the way that it would work is you'd simply you'd do a refinance, and you would end up, writing on a piece of paper what that pool loan is. Let's say it's $300 a month. What's your car loan? $500 a month. How long are you making those payments? Well, 8 years for the pool loan, and maybe, 5 years for the car loan. Make those extra payments for that exact amount of time. For the next 8 years, make that pool loan payment as you typically would. Make that car payment as you typically would. And what you're doing is you're going to actually pay your loans off quicker, because you'll be doing it at that lower mortgage interest rate than what your current pool loan or your car loan is.
Right. Taking that. Yeah, right. People get all excited. Oh my gosh. Well, you're right. You're describing the people who don't want to pay off these. They basically have an aversion to paying off their car.
Yeah, and typically people are saying, well, my dad told me, or my mom told me, or my aunt told me that I shouldn't do it. And it sounds like great advice. Don't do it, because you'll be financing it over 30 years. Yeah, I wouldn't want to finance my car over 30 years too. But what I do want is that lower interest rate.
So take the savings and apply it towards extra principal every month. That's
on your mortgage. That's right. That's exactly right. And that's just what we call smart money. So, we love doing these type of podcasts because they're super easy to do.
So, general rules of thumb as far as when a mortgage company is doing a loan for you on a refinance like this, they cannot go above a certain loan to value. What that means is you have to have a certain amount of equity in your home. And that is 20%. Okay, you need to have 20% equity in your home. If your mortgage is, for very easy math, $100,000 home, right? And your mortgage is $80,000. There is no bank that will give you a refinance above $80,000 to take any cash out, right? Because you are 80% of the value. Okay, your loan represents 80% of the value. So if you're in a situation where you basically have 20% equity, you are not a candidate for this type of refinance. The people who are candidates for refinancing is when they have a lot of equity, when they have over 20% equity. And generally, it's someone who has a $600,000 house, a $300,000 mortgage, and they have $100,000 worth of maybe debt that they can throw on top. So then we're basically financing a $400,000 mortgage, and their home value is $600,000. So you know what I mean? We're talking about these candidates who really have a lot of equity, and I just wanted to make sure to point that out.
Right. Yep, exactly. And I'm going through the Rolodex in my head right now. We've got a couple of lenders that offer seconds, but I'm trying to remember, what the cash out policy is on a second.
Well, the second mortgages themselves, when we do cash out refinances, even the first mortgage does not want the combined loan to value to exceed the 80%.
The 80%. Mm-hmm.
But there are banks out there and credit unions that will put a second mortgage up to 90% of the value. Those guidelines can change. And so I think for the purposes of this podcast, that's to be determined. We would have to check those guidelines. But yeah, the first mortgage is not going to be over 80% of the value.
Right. Yeah. And call us and we can kind of talk through things with you. Again, every month it seems like the rules and regulations are changing. But in general, yes, that 80% rule, and Ed, it's been that way for a long time, hasn't it?
Yeah. I'm looking at my wall here. Yeah. It looks like the combined loan to value is 80%. So, but again, we can always double check. If anyone has questions, just let us know.
We have walls that talk to us, by the way, people. That's right. We just stare at our walls and we're just waiting. You're waiting for something to happen. Okay, good. I like it. That's fresh and confirmed information that you gave us. So good.
All right, everyone. You have a great week. Be sure to like this video. Well, if you do, click on the like button, comment, click the notification bell, and you will be sure to be notified when we have new podcasts.
Awesome.
Take care, everyone.
Thanks, folks.
Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com, and be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.